The broadcast is now starting. All attendees are in listen-only mode.
Hi, Sandy Vicani here with Insurance Agency Marketing. I hope everyone's having a great Monday morning. I head up our life division here at IAMS and just want to say thank you so much for taking time out of your schedule right before the holidays. I know everyone is busy trying to get things done. So again, thank you so much for taking time this morning to attend what we believe is just such an important webinar on that infinite banking concept. So before I turn it over to a leader in infinite banking, Anthony Lawrence, I'm going to go through some house cleaning items here at IAMS. So here with IAMS, we have something called an IAMS Business Builder. And what that means is when you refer an agent over to us and that agent contracts, we will send you a $50 check just to say thank you for entrusting us with that agent. When that same agent writes and places business with us, from that point on, whether it's life, annuity, MedSup, long-term care, a combination thereof, you will receive 20 basis points on any piece of placed business, and that's indefinite. That does not come out of your commission. It does not come out of the agent's commission. That comes directly from IAMS. Again, as a thank you for entrusting us with your client or with your referral, your agent referral. We also have something for all agents called a marketing reimbursement account. And think of this account as a savings account for business expenses. For every $100,000 of placed premium that you do with us, we put $100 into this account. So when you have an expense, whether it be a seminar, a computer, business cards, website, whatever that is, submit that invoice to us. We pay up to 50% of that invoice as long as that money is in that marketing reimbursement account. And that continues to grow. If you don't use it for 1 year, it's not that you lose it. It just carries on into the following year. So that again continues to build up. It'll always be there for you until you're ready to use that fund. We also have something for brand new agents. So when you contract with IAMS in your first 6 months of being contracted and placing business, if you place $100,000, again, in first 6 months with us of business, you can choose a 2-year producer website, or you can choose a $750 cash bonus. If you would like to hold off and you think, gosh, in my first 6 months, I'm going to place $300,000 of either life, annuity, MedSup, long-term care, you can choose a $1,500 gift card. You can choose a $2,000 marketing reimbursement money, which is that account that you and I, or that we just spoke about. Or you can choose a Social Security program and 3,000-piece mailing. If you like to hold off because you think, gosh, I'm going to go gangbusters here in my first 6 months, I'm going to place $500,000 of business, you can choose a 4,000-piece mailing and seminar coaching with a top producer of ours, Dave Pimper, a 5,000-piece mailing and seminar coaching with another top producer of ours, Matt Gill, or you can choose my favorite, and it truly is my favorite, is a Ritz-Carlton Travel Rewards Getaway where you plan your own destination. And again, this does not come out of your commissions. This comes from IAMS as a thank you for contracting with us and placing your business with us. We also have such strong back office support. I truly believe it's just top notch in the industry, whether you're looking for case design assistance, if you're looking for forms, life and annuity quotes. If you give us a call and you're just having a difficult time, trying to understand or get into, for example, this infinite banking or, buy-sell agreement, whatever the case may be, we have top expertise in coaching for you. We set everyone up on paperless contracting to make it easy. So when you do need a contract in the future for any additional carrier, that we can get that completed for you with no additional forms. And out of all of this, what is so important, I believe, is that submission to commission. And what I mean by that is when you submit an application here at IAMS, we scrub that application, make sure nothing's missing, order any exams and labs that may be needed that day, and make sure that the carrier has that app the same day. We follow that application. We're touching that every 3 days. So that doesn't mean that we're going to be harassing you every 3 days with calls. It just means that we're looking at that case every 3 days to make sure that it stays on track to get issued and placed and commissioned out the door for you just as quickly as possible. So if you see any of our books, our life and annuity books, our newsletters, our website, our Facebook page, anything like that, our creative marketing team is responsible for that. Sean and Jacob do such an outstanding job, whether you're looking for handouts or flyers. If you have logo design or that needs to be refreshed or you don't have one, we can create that for you. A personal website, if you don't have a website for your business or you do have one and you're just not happy with the look, we'll create and manage that for you, as well as any online newsletters. Social media advertising, that is huge. So if anyone is part of Facebook and you look at Facebook for advertising, you can see how big that is. And if you're not comfortable with how to do that or you don't know how to do that, our creative team can help you with that. Make sure that we get you and your agency's name out there. Our website, I am in this website all day long. So when you give me a call and say, gosh, I need a term quote or a UL quote or I need some forms, I go to www.iamsinc.com, and that's where I pull all the quotes and forms when you give us a call. There's also current industry links and news. If you're looking on the annuity side at our top 5 MIGA annuities, you're going to find that, as well as our top indexed annuities. It has our long-term care product grid. It has a sales resource library. I can't stress enough what a great tool our website is. That sales resource library has different videos on there that you can look at. It has different sheets, whether you're looking to for a heart on the life side, a heart questionnaire or a cancer questionnaire. Great information on there. As well as under training, you can view our webinar schedule and register for any webinars. Or if you'd like to look at our past webinars, you can view all of our recorded webinars with just a click right off of our website. So if you're not registered for our website, I strongly suggest that you get registered. And if you are registered, take a look around and see what we have to offer. I will send out a poll question on this. When the DOL ruling came out, we thought it was just so important for the agents with IAMS to try to capture as much revenue as possible with their clients, so the clients don't have to go outside of you for any type of business. So with IAMS Wealth Management, it's here to help you increase revenue with managed money fees. You're able to offer a full range of products and services. And really important here, you strengthen your clients' relationships because you're viewed differently. You're viewed as a fiduciary, which is wonderful. So, there's been a lot of changes with the DOL ruling. There's been a lot of, suspensions of rules on that. The DOL ruling is not going away. We still expect changes. By checking yes, you're just asking for additional information on how we can help you. And, we'll be more than happy to get that information out for you. We also have a Life and Annuity Academy. Again, by checking yes, you're just asking for additional information. This is industry recognized. We're so very proud of this academy. Actually, Anthony Lawrence is one of our top speakers there. And what this is, it's a 2-day training event. We cover all of your expenses, whether you're looking for, or whether that's airfare, lodging, meals. We go over different sales ideas and strategies. Indexed annuities, we unravel those. When's a good time to utilize an indexed annuity? When should you use an income rider? Different seminar systems. Whether you're looking to do a small seminar where you serve coffee and cookies in a library, or your more formal sit-down seminars where you provide a dinner. large life case marketing, gosh, whether it's our great single premium life, which we rank nationally for, or whether it's the infinite banking, different wealth transfer tools. Again, cannot stress enough, we take between 35 and 40 agents. We had close to 1,000 register. Check yes. We'll get you out the information. Our next academy is in February or March of next year, and we'll get more information out for you. So in addition to great commission and service and all the other all the other carriers' incentives and trips, we here at IMES also found it really important to offer our agents a trip, and we do it, every year. It's a great opportunity for you and a guest to get to know the IMES family. And next year, August 25th through the 29th, we'll have our marketing summit at the Ritz-Carlton in Naples, Florida. In order for you and a guest to get invited to such a great opportunity, you have to place business with us. We have long invitational periods from January 1st, 2018, all the way through June 30th, 2019. Again, in order for you and a guest to attend, you need to place, either $3 million of annuity premium with us, $1.5 million of Medicare supplement premium, $2.25 million of single premium life, $250,000 of life target premium, or $600,000 of long-term care premium. Anthony's been to these trips. It truly is a family event. If you would like to attend, for you and a guest, again, in order to attend, you need to just make sure you're contracted and placing business here with IMES. We also have something really exciting. It's called Dash for Cash, and it is a $1,000 live drawing. Our next drawing is Friday, November 30th. In order to get your name in a drawing, you would need to submit a $25,000 or more Equitrust life, single premium life, or annuity application. That puts your name into the drawing. For every, again, minimum $25,000 app, your name goes in there. So if you write 5 apps, you get your name put in there 5 times. We just had a drawing this past Friday, and an agent just for writing Equitrust with us, he won $1,000. So if you're interested in that, please give us a call. Ask for any IMES marketer. We'll be more than happy to go over more additional information. That drawing is live on our Facebook site. It's facebook.com/IMES Inc. If you want to see the drawing from last Friday, I can't encourage you enough to go over there to our Facebook page, take a look at it. It was a lot of fun, and we're looking forward to giving away an additional $1,000 November 30th. And then we have another drawing December 7th, and then another drawing on December 14th. Again, great opportunity just by writing with IMES, your Equitrust life or annuity business. So right now what I'll do is I'm handing this over to Anthony Lawrence. Again, can't stress enough, he is extremely knowledgeable in regard to the infinite banking. He is, certified, I believe, Anthony. He ranks in the nation. He does an outstanding job. It's a great opportunity to hear him talk about this. And Anthony, if you'd like to take over, that would be great.
All right. Thanks, Sandy. And I can't stress enough for those of you who don't have a relationship with IMES just yet how vital Sandy is to my business. She's truly a wonderful resource, and really couldn't do what I do without the IMES team and Sandy's help. So with that, good morning, everyone. I truly appreciate your guys' time. I know, especially with this short week. So with that, happy Thanksgiving to everyone. It's hard to believe that we're already here. So I want to get right into it. I know if you have questions, I believe, Sandy, that they can just type in questions and we can address those right at the tail end.
Correct.
Okay, that's how we'll go forward then. All right, a quick background on me. Basically, I've been in the business for this is my 18th year. Got into the tail end of 2001 and did it the traditional way for about 10 years. Was independent for 5 of those years, and primarily my focus was on annuities, a little bit of life insurance involving universal life policies. And it was in 2011 when I ran across this concept by reading Nelson Nash and Becoming Your Own Banker. And if you haven't read that book, I highly recommend getting a copy and let that be sort of the introduction for you. And it was a book that really changed my life. And I took that information and explored everything I could, really tried to disprove this concept that I'm going to share with you guys. And so 8 years later, here I am, and it's really my bread and butter. It's what I love doing. I'm very passionate about sharing this information, improving my clients' financial situation, as well as educating other agents, other financial advisors on how this works, because it really is truth behind how money works, and it's not something that most of us are familiar with. And if I could see you guys, I'd ask you to raise your hands of those of you listening who are familiar with this concept, have heard about it before, and I'm sure a few of you have. So hopefully this information that I share with you sheds a little bit more insight. And please feel free. You're going to have my name, number, my email address to get a hold of me, and basically, if you want to implement this into your practice, I'd be more than happy to guide you and basically allow you to learn from my mistakes, so we can hopefully shorten that path to your success. So with that, I want to get started. Basically, let's make sure my computer's up and running here. Okay, there we go. So yeah, building your client's private financing system. That's typically what I call it. This is the infinite banking concept. There's many terms that you've probably heard of this: bank on yourself, private family financing, becoming your own banker. Everyone sort of calls it what they want to call it, but it really got started with Nelson Nash and the infinite banking concept. And that's the beauty of this idea and this process, is that it is what it is, and it does what it does, and has done so for the last couple hundred years. And so it's a really, even though it's new and innovative to most, if you share this with your clients or your prospects, but it's been around forever. And I won't get too much into the history of it, but it is fun to learn, and we can talk about that offline. So private financing system, what I want to share with you guys is what is it, how it works, and why you should be sharing this with your clients. So the private financing system, what is it? This is a definition that I use. It is a private financing system is a uniquely designed process that utilizes a properly structured dividend-paying whole life insurance policy to finance anything on which one spends money. Now, kind of break that down a little bit. It is a uniquely designed process. It's not just your average life insurance policy. If someone came to you without your knowledge of this concept and said, "Hey, I want to buy a whole life insurance policy," most financial advisors, most life insurance agents will utilize whatever premium dollar, or first they're going to want to determine what the amount of insurance needed is. Maybe they want a $500,000 policy or a $1 million policy, and then determine the premium. We sort of work backwards in the design. It's more or less, what is the premium allotted that we then reverse engineer and build that policy. Properly structured dividend-paying whole life insurance policy. For this concept, we do use whole life insurance. We don't use universal life insurance. Can it work with ULs? And I'll get into that a little bit later. Yes, it can, but you've removed several of the guarantees and the certainty behind it. So we, as a whole, most infinite banking concept practitioners will use whole life insurance to design the policy for their clients and prospects. And again, it's basically, in a nutshell, you're building high cash value life insurance to then leverage that money to finance anything on which one would spend money, whether it's for a business owner or for personal use. And we'll dive into that as well on how to leverage these policies. So what I always like to start off with is truth. And what Nelson, one of his quotes is, and I use it all the time, is if what you thought to be true about how money works turned out to be false, when would you want to know? And hopefully you answer today. And with that knowledge will take you far. But basically, one of my other mentors said, knowledge is power, but wisdom is the ability to apply that knowledge to our everyday life. So what would we do about it? And what are we currently doing? And this is basically what most of us, even you guys listening on the phone, are doing with your money, and what we're teaching our clients to do with our money, and what society has really taught us to do with our money. And that's to take our hard-earned savings and invest those dollars in some form of and park that money in some form of an interest-bearing account. And the most commonly used method of savings today is the 401k. There's 20-some trillion dollars sitting in qualified assets today. And we park our money and rely upon a rate of return. Do not touch that money for 10, 20, 30, 40 years. Use our income, our current cash flow, to buy what we want to pay for our goods, our services. And basically, this is what that looks like. So if we took the average Joe today, and let's just give him an income of $100,000. I know that's not the average earnings, but if he's making $100,000 and he follows suit with the average American, he's putting away about 5% of his income. It's actually dropped a little bit for 2018. It's down to about 3.9%. And I'm a student of history, and if you look prior to 2008, in 2006, 2007, our national savings rate was a negative 1.5%, which just is mind-boggling. It didn't benefit us at that time to save. And if you go back into the 70s, the average savings rate was about 14.9%. And so what has changed since then? And that's, again, going back to how money works today and what banks and Wall Street have spent billions of dollars in marketing and advertising dollars to convince us all that they are the solution and that we need to take our money and park it. And the 5% can stem from the matching of a 401k. If a company matches 3 to 5%, that's typically what people put in. So we're saving 5% of our income, or in Joe's case here, that's $5,000. But what this also means is that from January to December, $95,000 comes through the front door and goes right out the back. We're talking taxes, bills, expenses, debt, interest on debt, and lifestyle in general. We earn what we earn. We save whatever it is we save, and then the rest, comes in and goes right back out. And this is the way I would imagine you guys listening live your life. This is the way 99% of people live their life. They earn an income, they save what little they save, and they spend the rest. So if we focus on the $5,000 that Joe saved, that's where we put our attention. Put it into a 401k, give it to a financial advisor, and let's say he has a great year and he can earn 10% on that money. Now, it's going to involve some form of risk, but that's what we do. We park our money in some form of a Wall Street account, and we have a great year and we earn 10%. 10%, if you asked everybody on the street, if you could earn 10% each and every year, everyone would be happy. As a matter of fact, if you save $5,000 a year per year for 30 years and you earn 10%, you'll have $1 million. So we earn the 10% and on the 5,000, and that for that year, that would be a $500 gain, which would be pretty great. So my goal at Wealth Insight and what I do for my clients and prospects is I try to take the average Joe and make them prosperous. And what I do is I focus that 5% savings and say, we're not going to just park it and rely on a rate of return and leave that money alone. I'm actually going to position that where we have the ability to leverage against that $5,000. And what if I could show them how to recapture and show Joe how to recapture just 1% of that $95,000? And I will explain what recapturing means on the next screen. But if I can bring back and allow Joe to reuse 1% of $95,000. What is 1% of $95,000? Well, most people say $9,500, but it's actually $950. So if we could bring back with certainty just 1% using that $5,000, it took 10% to get a $500 gain, and that took risk. With certainty, we could bring back just 1% at $950. That's like earning a 19.5% rate of return on our money. My clients, on average, when they implement this concept, we show them how they can recapture somewhere usually between 3 to 7% of their income. So imagine if we could show Joe, or you could show your clients, how to recapture 10, 20, or even 30% of the money that's going out the back door. Would that improve their financial situation? Absolutely. And it's not that hard to do, really, if we knew how money works and we knew that it's more important, the velocity of money is more important than the rate of return. And what I mean by that is the average American out there, if you've read Nelson's material, and he's done quite an extensive study on this, the average American spends about a third of their money that goes out the back door on interest payments alone. Now, that might seem absurd initially, but if you look at how many of you guys have a 30-year mortgage? Or how many of you have ever looked at a 30-year amortization on a mortgage? What is it in the first 8 years that we're primarily paying? It's interest. If you add automobile payments, credit cards, student loans to the mix, it's no secret that we are spending about a third of our money on interest payments alone. And the idea is to recapture that interest, become your own banker, and actually have a system where you're paying that interest not to somebody else, not some other lending institution, but you're making the same payment you would, but now you're directing that money back to you in your control. So the key to understand, the principle to understand is who controls the flow of money? Who controls the flow of our money? It's banks. Banking is the most important business in the world. Without banks, all transactions would come to a screeching halt. Consumerism, as we know it, would be dead. Banks control the flow of money. And what I mean by that is, I'll give you a quick example verbally. I'm not going to go through a slide. It takes a little bit longer than the time we have allowed. So let's say you've got $10,000 and you park it in a bank, and it's my bank, the Bank of Anthony. And you put that money in my bank. To me, the bank owner, that's a liability because it's not my money, it's yours. And I pay you, let's say 1% for the convenience of housing that money. So this is a liability to me. It's an asset to you, but a liability to me. So I've got to turn that liability into an asset. And how do I do that? I could easily loan that money out. So let's say Sandy comes into the Bank of Anthony and she says, Anthony, I need to take out a $10,000 loan so we can buy a car. And I said, great, fill out this paperwork. Let me prove your credit, prove your income. And she gets approved, and I give her a loan for $10,000. And I charge her 6%. So I'm paying you guys 1%, but I'm charging her 6%. How much more am I making? Most of us would think 5%. That's what I thought when I first heard this. But it's not 5%. It's actually 500%. Because if I'm paying you 1% on that $10,000, that's $100. I'm charging Sandy $600. So I'm pocketing the 500, or 5 times what I'm paying you. Banks, Wall Street, financial institutions, they don't care about rate of return. They're more interested on the volume of interest. And it doesn't even end there. I hand a cashier's check to Sandy because she got approved for that loan. She leaves my bank, and the first place she goes is to whoever has that car, whether it's a dealership or an individual. She goes, she test drives the car, she likes it, she hands over that cashier's check. That individual hands her a title and a set of keys, and she drives off. Where does that person that she handed that cashier's check take that check? Right back to the bank. So banks just recapture other people's money, and they make a wonderful profit in doing so. And we can actually do the same thing within our own world. And I'll show you how. It's a matter of understanding really how money works. And if you remember anything about this presentation, remember this: we all finance everything that we buy. I'll say that again. We all finance everything that we buy. On one end, we traditionally finance by going to a bank or a lending institution or putting something on a credit card. Now we owe that institution principal and interest for the convenience of having that product or service today. That's traditional financing. And all of us recognize that, and we try to avoid that at all costs. And by avoiding that, what do? We pay cash. But when we pay cash for anything, we are forever giving up the opportunity to earn interest on that money. And that can be a huge amount of interest over time, because that never stops. And I'll give you an example here. So let's take a look at the screen. Let's say you were in the market to buy a car, and you had the cash. You kind of did it the Dave Ramsey way, where you saved up $30,000 in a money market account or a CD or whatnot, and you had that money ready to go, and it was time to buy your next vehicle. So you come into the bank, and let's again say it's the Bank of Anthony, and you said, Anthony, it's a great day. I've picked out a car I want. I've got the cash sitting in the money market account. I'd like to liquidate that, and I'll be on my way. And I say, no, there's a better way. I want you to think about this option. What if you left that $30,000 with me at the bank? I'll put it into a CD, and it's a 4-year CD about the length of a car loan. And I'm going to pay you a great rate. I'm going to pay you 4% interest on that CD. Now, I know you might be chuckling right now saying there's not a bank out there that gives 4%. This is a pretty nice bank. But the average interest rate on a CD over the last 35 years is about 4%. And we probably have the 80s to attribute to that, but bear with me, the 4% will come into play a little bit later. And if you do this, if you leave this money alone with me over 4 years at 4%, I will use that as collateral, and I'll give you a $30,000 loan so you can go buy that vehicle today. Now, it's a 4-year loan, so you're going to have to pay me back. And since I'm paying you a great rate of return of 4%, I'm only going to charge you 6%, and you're going to make money. Do you believe me? Now, most people that I share this with, they say, well, wait a minute, you're paying me 4, but you're charging me 6. How could I make money? I'm actually losing 2%. And that's where most of us go. But if we do the math, and let's break this down. If we do the math, a $30,000 CD over 4 years at 4% interest will grow to $35,196. We will earn $5,196 by leaving that money alone and letting it compound. A bank loan, obviously, you're going to have to make car payments back to me over that 4-year time frame. And at 6%, most of us would think it's got to be more interest. But in reality, you're only paying me back $33,818. That's $1,378 less that you earned. So you actually will be able to pocket almost $1,400 by leaving your money alone and leveraging it and borrowing against it at a higher interest rate. How is that possible? Compounding interest. Einstein said compounding interest is the 8th wonder of the world. He said those who understand it earn it. Those who don't pay it. And most of us pay interest unbeknownst to ourselves. We give up the opportunity to earn interest on our money because we use cash to buy the things we want and need. Basically, it works this way. The $30,000 CD is compounding. You're not earning 4% on $30,000 after year 1. You're earning 4% on $31,200. Your interest is earning interest. Whereas with the bank loan, it's a decreasing amortization. You're not paying 6% after year 1 on $30,000. You paid quite a bit of principal down. You're only paying 6% on about $22,000. So you've paid down principal, so you're only paying 6% on the principal you owe. And so the point to this exercise is you can actually earn 4% on your money and pay a higher interest rate and actually walk away with a profit. How many of you guys knew that? Because I didn't when I was first shown this. And what if there was a third option? What if there was a third choice? What if instead of storing your capital in someone else's financial institution or someone else's bank, what if you stored it in your own private financing system, which is obviously a dividend-paying whole life insurance policy, focusing on the cash value growth? And you had $30,000 stored up in cash value, and it was time to buy that vehicle. So instead of going to a bank and financing it, or instead of going to your bank and pulling the capital out of there, you go to your life insurance company and you say, hey, life insurance company, you are contractually obligated to loan me whatever cash value I have in my account because I am the owner of that account. And the insurance company will gladly loan you their $30,000 out of their general fund, meaning your $30,000 never leaves that account, and it continues to stay inside there and continues to earn a guaranteed internal rate of return. But you've got the $30,000. You borrowed from your policy $30,000. And if you're an honest banker and you honor this process of becoming your own banker, the infinite banking concept, you're going to actually charge yourself and pay yourself back. Now, why would you charge yourself interest? Well, first and foremost, the insurance company charges you interest for the use of their money. When I take a loan from my policies, anytime I take a loan, I charge myself 12%. Why would I charge myself 12% for the use of my own money? Honestly, because I'm worth it. That's the value of my capital to me, is I'm worth 12%. We should be charging ourselves interest for the use of our own capital. We don't do it, but we should be. And if we do it, it will improve our financial situation beyond measures. So even if you just emulated what the Bank of Anthony down the street was going to charge you at 6%, and you only charged yourself to 6%, and you, over a 4-year time frame, and it could be 10 years, it could be 2 years, you're in control of the loan, all right? So you don't have to pick 4 years. I have loans out there that are 2 years, and I have loans that are 10 years. It's just relevant to your situation. But let's to emulate and keep the example the same. Over 4 years, you charge yourself 6%, and you pay back that $38.18 of interest. What happens is a portion of that interest goes right back to the insurance company, all right? But through the form of dividends and interest earned, you get to recoup the $38.18 as well as that interest, that $51.96. That money comes back to you. The principal, the interest comes back to you. Now, the interest may not come back to you in the first loan or two, but you will recapture a great portion of that through dividends. But I'm going to show you an example here, an actual example of how you can recoup every dollar principal and interest on every car you ever buy, drive, own, and sell for the rest of your life. So you put that money back and you end up with $39,000 of liquid, tax-free, usable money inside your life insurance policy. So let me ask you guys this and think about this. Every one of you guys on the phone, do you remember the first car you ever bought? I would imagine you do. Information plus emotion equals long-term memory. So most of us remember, no matter how old we are, that first car we ever bought. Do you guys still have that car? Chances are not. And you've probably bought some vehicles between you and your spouse and your kids. You've probably bought quite a few vehicles over the years. Let me ask you another question. How much money do you have in the bank from any of those cars that you ever bought, drove, owned, and sold? More than likely, you're going to say zero. What if you had every dollar, principal and interest, plus the compounded growth on every car you ever bought, drove, owned, and sold over your lifetime? How much money would be sitting in a bank account right now? Probably a lot, potentially even more than what you have in retirement. I'm going to switch over and show you guys and actually Hopefully everyone can see the screen. Sandy, is the screen up?
Yeah, it looks great.
Excel? Okay, awesome. I'll keep moving. So this is an actual example. I'm I'm from Missouri, the show me state, so I like to see things. I like to prove it. By the way, Chiefs and the Rams tonight, Monday Night Football. It's going to be a good one. So I'm preparing for that. So, okay, so what this is I took an actual illustration and this is a participating whole life policy, a 25-year-old. Now, it doesn't matter if you're 55, 25, or 5 years old. It doesn't matter the age. Obviously, you're working with time here. And I took an individual, I gave him 25 male preferred, $3,000 base premium, and a $7,000 paid up addition. Most of you guys should know what that means. And what we did was every year, every 4 years, starting in the 8th year, we borrowed $20,000. And we charged the 25-year-old 8% every 4 years for an annual loan payment of $58.46. So he basically borrows $20,000, pays back $23,440. So what we did here was we deposited or paid a premium of $10,000 for the first 7 years, as you can see in this third column. Okay, this blue is the cash in the private financing system. Obviously, this is the death benefit. I'm not going to really focus on the cash and investment account. I basically wanted to prove that you can bank not just using a whole life policy, but why it's better to do so. So this is an example that basically says, what if we did this using just an investment account that earned 5.5% every year? Nelson Nash did this same thing in his book, so I wanted to emulate that. So I'm not going to focus on the gray, but more on the blue. Notice we've put in $70,000 over 7 years. We've got about $70,000 of cash value. All right, so from a rate of return perspective, it's not that great, but we built an asset, an ever appreciated asset. Years 8 through 14, so for the next 7 years, we dropped off the $7,000 paid up addition and just paid the base. Years 15 and on, and I'll scroll down here in a minute to show you, we're not putting any more premium, no more out-of-pocket cost for this 25-year-old. All right, so he's going to pay 14 years worth of premium. Now, I would never necessarily recommend doing this for any of my clients or prospects, but I wanted to show and compare the true growth behind borrowing from your own banking system. So here we come, beginning of the 8th year. It's time for him to buy a car. He's now 32 years old. He borrows out $20,000 from the $69,829. He then pays back the the $20,000 plus 8%, plus he's got 4 more years of paying premium. His total premium and loan from day 1 all the way to year 12, plus the car payments, his total out-of-pocket cost, how much money he's outlaid between the car and the premiums, is $103,000. His policy went from $69,829, borrowed the 20, paid back the $23,440. He's got $99,838. That's about 96 cents recouped, recaptured for every dollar he spent so far. Plus, he's got a $758,000 death benefit. Actually, in the investment account, there's a little bit more. The reason there's more is because there's no cost of insurance over here. Year 12, it's time to buy car number 2. So he's now 36 years old. He's got $99,838 in his private financing system in his whole life policy. He borrows the 20, pays back the $23,440, plus he's got 3 more years of premium. His total premium and loan repaid for car 2 is $32,440. This amount plus this amount over here, the second column or the third column and fourth column. $32,440 is his total out-of-pocket cost. His cash value went from $99,838 to $134,179. That's an increase of $34,331. How much money did this car cost this guy? He spent $32,440. That included premium, and he's got 34,331 plus a paid-for vehicle that has some value. This car didn't cost him anything. Let's scroll down and let's go actually to the fifth car payment, or the fifth car loan. So here we are. He's 48 years old. He's got $206,550 in his whole life policy, almost an $800,000 death benefit. He borrows out the 20, pays back the 23,440. No more out-of-pocket premiums. His cash value went from 206 to 256. That's an increase of $50,000. How do you like buying cars this way? And you guys think about this. He's got $206,000 sitting here. Can he afford a nicer car than $20,000? Or could he afford 10 $20,000 cars? For him, his spouse, his kids, his brother-in-law, his parents, he could finance everyone's car in the family and have them pay back this interest. Notice on the investment account, he had $186,000 sitting in that investment account. He borrowed out the 20, paid back the 23,440. It went to 218. That was only an increase of 32,000. Now, like I said, this will work. You don't have to use a whole life policy. But why would you give up an $800,000 death benefit, guaranteed growth on your money, plus the ability to loan against that at any time? We can go all the way down. His last vehicle, 72 years old, he had $727,000 in there, borrowed the 20, paid back the 23,440. His cash value grew to $929. That's a $200,000 increase. I won't really get into this down here, income-wise, but basically the point is I've proved this example. This was actually using an actual example from an illustration, plugging the numbers in there, borrowing against it for 11 car cycles, and it showed that you truly do get back every dollar, principal and interest, on everything you buy. So like Einstein said, imagination is more important than knowledge. That was just in a car example. What if you implemented this for all of your uses, all of your needs, all of your marketing expenses for your business, your clients who are business owners, their inventory, their expenses, their vehicles that they're buying within their business, their taxes, their payroll, anything and everything you can leverage against your own policy and continue earning that compounding interest. How does it work? How do you build your own banking system? What does that look like? So let's look at a 5-year time frame. And Nelson Nash said everyone should be in two businesses: the business they're in, which we're in insurance and wealth management, and the business of banking. And in order to start your own banking system, do we have to go out and emulate what a bank does? No, and thank goodness, because that would be very, very expensive. We don't have to go find a piece of property, construct the nicest building on that block, hire the help, advertise, have $15 million and be chartered by the federal government. We don't have to do any of that. All we have to do is plug into a properly structured, dividend-paying mutual life insurance company. They've already got the building. They've already got the administrative staff. They do the advertising. They do all of that. What we do is we basically pay a premium. And in year one, let's say we put $1 into our banking system. And I'm using small numbers because it's easy math. Immediately, once we put that $1 in, we have access to about 57 cents of that dollar. We had a pretty good first year. If you think about it, if you're building a business, name me one business out there that you could put $1 into, or whatever dollar you put in, you could actually leverage 57 cents of that dollar out. There's not too many businesses out there in year one where you have any capital available. So year two comes along, we put our $1 in, we have access to about 60 cents of that dollar. So we had a pretty good second year. Now, we've put in $2 into this business, okay? And we've got $1.17 available. Now, someone like Dave Ramsey might say that's a horrible rate of return. You would be an idiot for doing this. We're not looking at rate of return. We're looking at buying an appreciable asset. We're building a business, all right? And banks banks that go out and buy the land, construct the building, hire the help, it takes, on average in this country, a bank 7 years before they turn a profit. But obviously it must be worth doing, okay? So let's keep moving. Year 3, we put $1 in. We now have access to 90 cents of that very dollar. Business is getting really good. And it's usually that 4th year when you put $1 in or you pay your premium, you can actually leverage 100% of what you put in. Meaning if you put in a $10,000 premium, your cash value should grow to about $10,000. Sometimes it's a little bit more, sometimes it's a little bit less. It depends on age, tobacco rating, and rating in general. But for the most part, it takes right out about 4 years to be dollar for dollar efficient. And the best part about this is every year thereafter, when you put $1 in, your cash value grows greater than that dollar. I just paid my 8th premium of my first policy. I've been doing this since 2011. And my very first policy, I have 8 policies right now. In my very first one, I just paid my 8th premium in September. I put my dollar in premium, and my cash value grew by $1.49. If you had a bank down the street that said, hey, you've been banking with us for 8 years, every dollar you put in this year, we'll go ahead and give you that dollar plus an additional 49 cents. How much money would you stick inside that bank? Probably every dollar you had. And that's what we're creating. We're creating basically a perpetual wealth system that forever increases. So again, from here, every dollar you put in, you'll be able to pull more than that dollar out. So how does it work? We use mutual companies versus publicly traded companies. The reason being is because the profit, that dividend, doesn't go back to a stockholder. It goes back to you, the owner of the company. It's kind of like a co-op. Direct versus non-direct recognition, I won't get too much into this, and the more I do get into this, it really depends on who your client is, whether or not I would offer a direct versus non-direct. Basically, for those of you who don't know, a direct recognition means when you take a loan from your policy, the insurance company basically recognizes that loan, and they will reduce or lower the amount of dividend that they pay. A non-direct recognition does not recognize that. There's actually pros and cons to both. I won't get into too much of that right now. It's the companies that IAMS uses, the companies that we've established relationships with, some are direct, some are non-direct. Both of them offer, they're wonderful policies to use. It just depends on who the person is. Obviously, we use paid-up additions riders to overfund, to overpay, and that's what drives the cash value in the first years. Oftentimes, we actually drop the paid-up additions rider off after it becomes fully efficient. Again, UL, IUL, I stressed on this. The number one reason I don't use a UL or an IUL is because it's based off of a term chassis. That means the cost of insurance is going to increase as the older the person gets. And if someone has leveraged all of their money out of the policy, they have no cash value. Something happens to where they're not able to pay that money back. Their cost of insurance goes through the roof, and they don't have the money to basically even make their premium payment because they're 89 years old and still alive and still having to make that premium payment. The policy could implode, and now there's a tax liability. I don't want to deal with that. So I use whole life insurance policies for banking. I'm not opposed to ULs or IULs from an accumulation perspective. I think they can be very powerful. But from a banking perspective, most people you find who are practitioners of this concept will stay away from ULs or IULs. Do they look more attractive? Can they be illustrated at a much higher rate? Sure. And if in a perfect world where the stock market did, the 7 or 8% every year, great. It would probably work out really well. But I don't like to take that chance or risk. I like to deal in certainty, not risk. So I don't use IULs. Let me go through. Sandy, do we have enough time? I've got a couple minutes here. Maybe I'll go through a quick case study.
We have about 5 minutes.
Okay, perfect. All right, guys, I'm going to fly through this thing. This is an actual case study, and this is the power of what you guys can do for your clients. And this is what I develop for each and every one of my prospects and clients. And typically, if I have the opportunity to sit down with them and share this information and show this information to them, they say, where do I sign up? So let's go through this. So I've got Mr. and Mrs. Jones. These are real clients of mine. They're out of Kansas, 56 and 50. Their combined income was about $120,000. So they had just started a couple years ago when I met with them, putting money into basically a SEP IRA. They had about $54,000 combined. They were each contributing $1,200 a month. I had $20,000 in their savings account. The male had a Prudential whole life cash value policy had $19,000 of cash value. We did not touch this. It was a good policy, so I didn't replace this. They did have some insurance. They had term, $500,000 each. Notice her premium was $561. She had a return of premium rider, 30-year term. So what we did was, well, first they had debts. So about 6 debts, mortgage, second mortgage, 2 car loans, credit card balance, and a student loan, a Parent Plus loan. I like to break down the volume of interest for my clients. So of the $900 monthly payment, $600 was going to interest. Of the second mortgage, $320 or 33% was going to interest. When you show your client or prospect how much money of their actual payment is going towards interest and that they could recapture that, it really makes a big difference. So their current outlook, $120,000, $76,000 after-tax dollars. Of the $76,000 throughout the year, $49,000 was committed to those third-party payments. So about 65% of their income was going to those debts. And of that, about $17,700 or 23% of their income was going to interest payments alone. And if they completed this plan to completion with no new purchases, which we know would never happen, about $494,000 of their income would be transferred to third party, and over $150,000 of that would go to interest over the life of that debt. So I make recommendations, and my recommendation was pretty extreme on these guys. And I basically had Mrs. Jones sign off and say, you know, I do not want you to do this unless you are fully committed. And she basically said, Anthony, I will follow to a T your instructions. And she has. It's been 4 years now. And it really is amazing how much debt they've recovered. So I basically said, we're going to use $45,000 of that existing IRA money and create a $30,000 annual premium on Mrs. Jones and a $15,000 annual premium on Mr. Jones. Now that means we took that $55,000 of IRA and we liquidated it. We paid the penalty and the taxes. Now I don't recommend everyone do that. Basically, I leave that up to them if they want to. That's how I built my first policy, was my 401k. Because it's all the money I had at the time. And so I said, if you do that, and I told her, and she basically, pretty smart woman, said, you mean to tell me you're going to create a $45,000 annual premium? She said, we don't have that kind of money. And I said, you do. You just don't know where your money's going. So I had them stop putting the $2,400 into their SEP IRA and redirect it to a separate checking account. We immediately borrowed $21,000 from their life policies, and we bought their credit card debt. They were paying $775 a month on that credit card debt. They're now redirecting that back to that checking account. I had her get rid of the term policy, but I asked her, I said, Mrs. Jones, are you used to paying that $561 a month? She said, yeah, it doesn't bother me. I said, why don't you just treat it like savings? So she redirected that $561 back into the separate checking account. We borrowed the remaining $2,800 from the life policies, plus we borrowed $10,500 from his old Prudential policy, and we bought his automobile. We redirected his automobile payment of $395 back into that checking account. So in the first month, we recaptured the credit cards and his car payment, about $34,500 of debt, redirected $4,131 back into their system. It gave her a $762,000 death benefit, and him, on top of that $500,000 term, an additional $195,000. And that looks like this. So I build these for my clients every time I share with them. So this is not that confusing here. This is policy one outlay for her, policy one for him. The 30,000 plus the 15,000. That's the 50 some cents of every dollar available, or about $23,892 available. These are those 6 debts: the credit cards, the 2 cars, the student loan, the second mortgage, and the first mortgage. We immediately took care of the first 2 debts, redirected this money back to a checking account. At the end of year 1, how much money is sitting there? About $49,572. Is that enough money to cover the next year's premium? And it was. And you guys, she had that dollar to a penny. She had $49,572 in that account. So we paid the next premium. We're able to capture the second car. Now we're putting $4,887 back, bringing back $58,644. In 26 months, we're able to actually buy their second mortgage. Zero. They're putting $6,000 a month away. Go down to the 4th year and 4th month, or 52nd month, we bought their first mortgage. Now they're putting $7,000 of monthly cash flow back to themselves. So going back to the system, or this word here, in 4 years and 4 months, all third-party debt is recaptured. There's a $165,000 loan from the policies, but they've got $7,000 a month of available cash flow. If they wanted to pay that off, it would take about 2 years. And let's say they did do that. In 6 years and 4 months, all debt is paid off. They've got $7,000 monthly cash flow. They've got almost $1.2 million of death benefit combined, and their life insurance policies have a little over $200,000 sitting in them. If I show this to my clients and show them this breakdown, very rarely do they say, no, I'm not interested. They say, where do I sign up? And the life insurance becomes a formality. It basically becomes kind of part of it. So the benefits to you guys: get in front of existing clients, annuity clients that are not using their 10%. Show them how to spin that 10% off into a policy, whether it's on them or their kids. Again, you have a reason to talk to kids or grandkids. I write a lot of policies on 30 and 40-year-olds, not usually someone we like to talk to. The commissions are great, mainly because if they do this the right way, they're going to buy additional policies. The renewal income, every year they make their premium payment, you get a little override of that. You've got me as a resource. I love, love, love to teach you guys, to share what I know with you guys. Step 1 for you, my advice: read Nelson Nash's book, Becoming Your Own Banker, and then get a hold of me, and I'll share with you what we can go through, depending on where you are in your business and your practice. Basically, I do charge for my time, but it's relevant to your situation. But with what I offer, case studies, analysis, I've got my PowerPoint presentation, which I only gave you guys a fraction of it here. That debt flow analysis through the Excel template, ongoing education, workshop presentation assistance, and I use a direct mail piece that really works. It produces results. So that's my information. Jot it down and get a hold of me. Shoot me an email, send me a text, or give me a call, and we'll set up a time to half an hour to do a one-on-one and see if this is something you want to implement into your practice. So that's about it, Sandy.
Okay, so what I'm going to do, just real quick, and again, everyone will receive this webinar in a recorded version. We have one of the top carriers, Security Mutual. If you'd like to get contracted with them, they do an amazing job with this infinite banking concept. We'll be happy to answer any of your questions. Again, you'll receive a recorded version of this webinar. Myself, I will be personally giving you a call. I know that Anthony's information will be on here as well. Cannot stress enough what a great opportunity. I know a lot of agents think, gosh, I don't want to learn something new, or this is too complicated. Anthony makes it really nice and easy to understand. So greatly appreciate everyone's time. I hope everyone has just a wonderful and happy Thanksgiving. Safe travels to anyone who is traveling. Anthony, again, thank you so much for taking time out of your busy schedule just to teach this. And again, everyone will be receiving a recorded version. So greatly appreciate it, and everyone have a great week.
Take care.